The best investor of our time, and many people can agree, is Warren Buffett. He's done really well over his time. The question was that when interviewers came up to him, they said, Warren, your investment strategy is so simple. Why don't more people do it? And what was his answer? You guys know? Because nobody wants to get rich slow.
All right, so welcome to another episode of the Life Rocket University. Today we will talk about investing. We've got Roman here.
My name is Roman Kinzerski. I've been in the financial field of financial services, wealth management, and insurance for the last almost going on 5 years or so. It's funny how people always ask how long you've been doing something or how many years you've been doing something, because they never ask how much time did you actually work in that, right? Because my 4 years that I've spent in this industry, I've spent it as self-employed, and I've spent it working for myself in my own office and my own hours. And truth be told, for the first 2 years, I worked around 100 hours a week, mainly because I remember seeing something along the lines of working harder, a little podcast, a little interview of Elon Musk, and he said that if I work 100 hours a week and you work 40 hours a week, like the average person, I'm going to accomplish what you would have accomplished 2.5 times faster. So just to all the viewers and to all the people that always ask, oh, how long has this person had the experience? Sure, as far as the markets go, of course, time runs just as fast for everybody else. But I have put in a substantial amount of hours in what I do. Like I said, 3 to 4 years. If you multiply that by 2.5 times, which is an average of 100 hours a week, it's more like 6 to 8 years of experience. Even more than that, because some days I work through weekends and stuff like that. So I do have a lot of experience in this topic. I've managed to accumulate a total current amount right now, after about 2 or 3 years, of about $14 million of assets under management and growing. Last year, my clients have gotten an average rate of return of about 23% on their portfolios. I know it was a good year, but the year prior to 2022, when the markets were generally down, my clients still got an average of about 17% rate of return. That's mainly because I used certain sectors and certain funds that allowed us to still continue to grow even when the markets were down. Of course, 2021 and 2020 was a great year as well. 2021, we had the US or the Ukrainian-Russian war as well, so we had to pivot and change some things. But at the end of the day, I am fairly qualified and skilled at this topic. So the investing strategy, Michael, if you don't mind, could you just repeat that question for me?
Yes. What is your investment strategy and how it has evolved over time?
My investment strategy. Okay. So my investment strategy is always very simple without complicating things. Rather than spending countless hours researching certain companies or certain stocks, if you generalize it, I mean, at the end of the day, look, the way I see it is that if you guess a certain company or a certain stock, sure, you might have a very massive, opportunity to gain and high leverage and everything else. But it's much, much, much more difficult than trying to actually evaluate a certain sector or an industry rather than a certain company. Meaning that if you generalize it a little bit, you're still going to get 80% of the results in that industry, rather than, the 100% results you would have got with that single stock that really blew up. Because again, you're kind of playing a guessing game. And honestly, unless you're spending an average of like 4 to 5 hours a day, researching and doing self-directed trading constantly and analyzing different companies, you're probably not going to be one of the few that does guess the stock that blows up in a year. Now, when you're talking industries or sectors, that's a much more general topic that we can link to our conversations. And again, like I said, even if you get the right type of strategy for a sector or an industry, 80% of the results are still going to come. So my investment strategy is very, very simple. A lot of you guys have heard it. I keep it as primary and as fundamental as possible. And that's the investments that we choose, and the investments that we typically go into should never go to zero and should always be growing over time. Very basic. Now, if you apply that to anything just like extremely tangible, just to give you guys an example. Michael, what kind of phone do you have?
iPhone.
iPhone, okay. And who do you bank with?
TD.
Beautiful. And Josh, what kind of car do you drive?
Toyota.
Toyota. Okay, here's my example. Those are obviously the biggest companies. So if you take a look at those examples, like if we sat down right now and we said, well, guys, those are obviously the most used titans of their industries. Why don't we just invest in those? They're bound to go up. We're bound to make money. Yes, but in a nutshell, if you keep it very simple to make sure that you never go to zero and always grow over time, it doesn't actually quite pass those rules. Because as big as those companies may be, let's say Apple, okay, you can't really guarantee me that Apple will never go to zero. However, because Apple right now, their bread and butter is handheld devices and technology. If you look past, in the track record of history of technology companies, even the company that brought handheld devices to the market, like Nokia, for instance, is no longer the titan of their industry. So somebody who invested in Nokia when they first came out with those brick cell phones, everybody around us, in the 90s or whenever that was, would have said, oh, of course they're going to keep going up. They're the first company to ever introduce this. They're going to revolutionize the entire industry. Where are they today? If you invested $1 million in Nokia back when they were blowing up, do you really think you'd have the compounded interest you would have that you invested in Apple? Of course not, but nobody knew about Apple as much as they did about Nokia. Same thing with like BlackBerry, Motorola, Sony, ton of examples, right? Because at one point those guys were killing it, and like nothing in the world would have made us think, well, there's no way they're going to lose. They keep putting out good products, but things change, things adapt, and it just doesn't pass those two rules. Even your bank, Michael, you said TD Bank, for example, great bank, one of the largest banks in Canada, in the top 5, right? We have RBC, BMO, TD, CIBC, and Scotia. However, you still can't guarantee that they'll never go to zero. Even when the term bankrupt came from, it actually came from, like, if everybody withdrew their funds out of the banks, what's going to happen to the banks, for example, right?
They're done.
Exactly. If you do some research, 1991, a major Canadian bank went bankrupt, lost tons of capital.
Well, it happened all over the place, right? It's US everywhere, right? They got bailed out, and especially after the 2008, that was all what it was.
2008, United States financial crisis. Of course, Lehman Brothers went bankrupt.
Yep.
And recently Silicon Valley Bank went bankrupt. So there's been plenty of examples of banks or financial institutions. So it's also not a guarantee typically. And so people who think that the banks are safe, that just kind of debunks that theory. And then lastly, like Toyota, like Josh was saying. So Toyota is actually one of the best car manufacturers in the world. But again, you can't guarantee me that they'll never go to zero. You've seen some titans of the industry, like General Motors, for instance. They own GMC, Cadillac. They used to own Pontiac and Saturn, Chevrolet, obviously. They were bankrupt in 2009, and the government had to bail them out with about $3.6 billion because they couldn't afford Lehman Brothers and GM going bankrupt in the same year. That would have crushed the economy. So just like plenty of examples like this, that even though it may seem obvious, just because you're an internet warrior and you think you know the company that's going to be the big blow up next, it doesn't necessarily mean the truth, right? So you really have to spend an adequate amount of time. I'm talking like almost like a side gig or a full-time job to really do well trading stocks on your own. You could play the guessing game, but you might as well just go to the casino or buy a lottery ticket. You get the same result. So my investing strategy is super simple. Make sure whatever you're investing in never goes to zero and always grows over time. At least if you're relying on those funds to be building your wealth. I'm sure we've heard of tons of people who made tons of money through Bitcoin or through buying a random stock or crypto and something like that. But again, if you look at the sustainability for a longer period of time, that just doesn't have the track record that we're used to. If we look at something like the general markets or economies or S&P or whatever you really use as an example, they've been trending upwards since we could track them, right? If you look at
so just to follow up on this question, this great answer you gave us, what because anything could almost go down to zero, or what would be the stocks, or what would you invest in that never goes to zero? For me, that would be real estate, because real estate always keeps the value. So what would you suggest other than real estate is a good investment for the listeners and would never go to zero?
You're 1,000% correct. That's absolutely correct. And that's the idea. And that's the example I used. Real estate never goes to zero for one main reason. It's all land. The value comes from the land, not the property. That's why you can buy a house in Texas for $170,000 versus in Vancouver, it's $1.5 million. The land never goes to zero. And with inflation, it always goes up over time. So you see that actually pass those two rules right away. That's me breaking it down a little bit more straightforward for you guys. Because land keeps growing and land is scarce in the world. So eventually we're going to run less and less and less land. So it's actually going to go up in value. And another thing that passes those two rules is, this is really important, actively managed funds. Active management, aka has a CFA or a portfolio manager who's constantly watching over those funds to make sure that they go up. And that can be an example of like segregated funds, hedge funds, mutual funds, in many cases trust funds, whatever, if they're actively managed trust funds. So whatever has a vast diverse, so two things, it's got to have diversity, it's got to have more than one options, and it's got to have active management. It means that you have the ability to constantly change what's going on in it. Now, the difference is with passive investments or index funds in a certain format like that. When you look at index funds, for instance, what those are is basically just a grouping. So I'm going to use a metaphor here to give you guys a better understanding, but imagine like a soccer team with the best players. Let's say that this soccer team has all the best players. They're new players. Some of them are up and coming. Some of them have been around for a while. Some of them just joined the league, and you group them all together into a group, and you made a team out of those. That would be like an index fund. That would be like the S&P 500 or the Nasdaq 100, because the Nasdaq 100 is the top 100 technology companies in North America. So you just group those up and you put those together. Versus an actively managed fund is typically like a soccer team, let's say, with hand-chosen players. Could be again the same players from the other team. But now it has a really great manager, it has a really great coach, it has a really good, recruiter or a headhunter for new players. And he's always scouting to see which players are going to be coming next. And typically what ends up happening, now there's a lot of funds out there. When I took my exams about 3-4 years ago, there was about 10,000 different actively managed funds in North America. It's a really wide variety of types of funds. And my opinion is like 80 to 90% of them are kind of crap because they have poor management. They don't have consistent performance. Their fees sometimes too high. But when you're looking at some of the top rated ones, and I mean, you're probably going to have to sift through some stuff. And that's kind of what I do on the back end of things as far as wealth management, changing those funds, because I have access to over 100 different asset management companies. I'm able to actually not just use one or two, but over, let's say 50 to 100 on average in North America, and be like, okay, these guys are doing some pretty cool stuff. We, lean into that growth for a couple months, and then we, hop over here to catch the wave of this trending fund or whatever with another fund company or something along those lines. And then what ends up happening is an actively managed fund will have the same kind of diversity of players, so 100 to 1,000 different companies inside this fund. But the really cool thing is that you have a CFA, which is a portfolio manager, essentially, certified or chartered financial analyst. And he's constantly watching over this portfolio day and night. It's his job. Now, some people have this illusion that it's like one portfolio manager making sure that everything goes smoothly. They imagine it like a Starbucks with just one manager who's making sure that everything's running smoothly. Not necessarily. Again, the fund companies that do really well and that make a lot of money typically have multiple aspects of that management. So they have the CFA, but they also have a team of analysts that are helping him. They have a team of researchers. Yeah. Again, headhunters on the ground. They'll have people who sit in the boardrooms, like some of the top CFAs I know from fund companies like Fidelity, for instance, Mark Schmel. He actually lives in San Francisco and he manages a lot of tech-based companies and funds. And living in San Francisco gives him the ability to attend all these different seminars, networking events with technology, CEOs, CFOs, and their company leaders. Yeah. Which, taken a step further, of course, because Fidelity is one of the largest shareholders in NVIDIA, for instance, the chip making company. He can call audience and sit down with the CEO of NVIDIA at any point in time. Gives him a tactical advantage to be able to assess and manage these companies. So on the ground, constant footwork. So the management expense ratio is the cost of the fund that we pay. Right? Just like when we buy real estate, we pay realtor fees, lawyer fees, property transfership tax, GST, all that stuff. With a fund, you're looking at something called an MER, a management expense ratio. Now, really key thing to remember that typically any additional fees on top of that are entirely up to the advisor. That's why I disclose all this stuff in my meetings with clients. I say I don't charge you any additional fees because I already get compensated on the back end. Some advisors will charge something called a front-end load, which they'll charge you right out front for 2%. They'll charge you a deferred sales charge or intermediate charge, and they'll charge you a back-end load. So you end up getting charged 3 or 4 fees. So a lot of your gains actually ends up leaving your pocket because of that. I don't charge anything up front. The only fee or the only cost is the MER inside built into the fund. And all the funds that I show, all the funds that I recommend typically have a double-digit performance over the last 10 to 20 to 30 years. Which means they're doing 10% higher compounded interest every year. They're all after fees. So that's not like 10 to 12% minus the MER. That's already after the MER. And frankly, I just care about what ends up going into my pocket, because if I'm paying a server to serve me or a waitress as tips, as long as she's filling out my coffee and bringing my food while it's hot, I find that tip is justified. But it's when those MERs, like I said, with the other crappy funds, when you end up spending all these costs of fees for a crap fund, that it ends up giving you 10% and then you pay 3% in fees and you only keep 7%. Well, you could have just invested it in an index with a 0.5% in fees and walked away with significantly more, right? Or an ETF, something that has a 0.1%.
And now, Roman, like this is just, I wanted to follow up on this because there's a lot of great information. And This is just from my experience, watching some of and kind of going and learning about 2008. And there was these derivatives, right? Which basically is that the bank decided it, especially with the mortgages back then, they would say, well, it takes us 30 years for people to pay them off. So why don't we put it in these packages, right? Because that's what it was. And we'll sell it to investors, right? What a great new invention. So now they were not holding the bag. They passed it on to investors. So they now, and the problem, I guess, looking back, was that now they didn't really care if the people will default, which opened up the floodgates for people getting mortgages that shouldn't get the mortgages in the first place, right? The second part of that was that the rating companies were actually not doing their job. They said, well, it's our opinion, right? They rated them with much higher rating than they should have got. And some of them were at the verge of bankruptcy and they were like triple A's. So did that change in the current situation? Because I'm hearing and kind of doing a little bit of research for our podcast here that the same thing is happening. However, now it's even with students loan, car loans, probably mortgages. I'm not sure if that got regulated or not. And that there's this almost like the market is doing really well, but you don't really, it's kind of the same thing until someone calls it, like who's going to be the one holding the bag at the end?
Yeah, it's a great question. And honestly, anybody that's interested in learning about what happened in the past, as far as that's with mortgage bonds you're referring to. So bonds,
Yeah.
there's difference between equity sectors and fixed income sectors. Equities is more stocks when you're trading and shareholding in a company. And then bonds would be the other side of that, which is a fixed income, which is typically lending for a purpose. So it's more of a loan value rather than just ownership. If you want more clarity or answers exactly what happened and how it happened, go watch the movie The Big Short. It's probably the best explanation of what happened. It's
Yeah, an inside job. I think it was the second one. I watched it a couple of times. It really gives you an idea
I haven't
what went
seen
on.
it, so if you want my stamp of approval, I'm gonna have to watch it first before I recommend
Oh,
it.
definitely watch it, man. Like if you haven't seen The Inside Job, it's one of the best movies because they actually show everything like how it happened. They have the interviews and everything has been they did a really great job. And basically what happened was that they after all of this, which I was, shocked to find out, and this was mainly in US, but the government bailed everyone out. So you had all these fraudulent activities that were taking place, and then the taxpayers end up covering the cost. And these guys that were, the main managers of the bank basically walked away with like $400 million in um, bonuses for those few years, right? Because they were selling all these crappy mortgages to people that shouldn't get them. And they didn't care because they were not the one holding the bag again, right? Because they just got the mortgages, got the fees, and then they sold it as a triple A, or really good bond stocks or whatever, or investments. And then they didn't care anymore. And then eventually, failed. So definitely a movie to watch, I would say. And let's go to my second question here. I think that we've kind of really went on for that one. How do you conduct research and stay informed about investment opportunities?
How do I conduct research and I stay informed on
Investment opportunities, like what is good to
investment
invest in?
opportunities? That's a great question. So because I do so much business with some of the larger fund companies and asset management companies in Canada, which also double dip in the US as well. I get the opportunity to actually sit in and go to a lot of their events that include like market updates, that include analysis updates. Like we actually just had one. If you guys are interested, I've invited you guys, I think a few times in the past. If anybody's interested, reach out to me. We do have some exclusive sessions on Saturdays. Like
Nice.
we just had the vice president of Fidelity come on and give us an evaluation of what we saw in the previous couple of years, what we're expected to see in the next couple of years, which sectors and why we're leveraging them. Again, I don't really have the qualification to talk exactly about those specific topics, which is why we do the Saturday sessions in particular. Nor do I really want to. It is kind of more or less boring to me sometimes, but I understand it well, and just why I leverage it. Why I
Yeah,
say
but you guys are using like the experts, right, that are doing all of this stuff and you tapping into their expertise, right?
and don't
And
get me
what
wrong, I really appreciate all that. It's just that I'm a very fast-paced guy and I'm very efficient. And I think sometimes when it takes like an hour and a half to kind of go through all that content, I could have honestly been fine with 5 minutes of a synopsis of what they talked about, right? Like,
Yeah, yeah,
here's what
100%.
we're leveraging, here's what we're using, and why. That's why. So sometimes I just kind of zone out. But if you're interested in that stuff, then absolutely, there's some great topics that we cover, and that's how I stay up to date, man. Because like the best way to be good at anything, like you want to learn to be a good golfer, go shadow a professional golfer, go play with them, go get them to coach
Yeah.
you. I'm constantly kind of doing that and pivoting in different sectors and using the track record of good portfolio managers. Not just people who won once or twice, but consistent track record and seeing what they've been doing. As well as like there's multiple layers of management in what I do, especially like if somebody comes to me and they ask me to be their wealth manager or wealth advisor, they got me watching over, switching from fund company to fund company, from investment to investment in different funds, in different institutions. Then they have the actual representatives and the institutions themselves, which will typically also give me guidance and advice as far as to which funds they recommend using. And then there's the fund and the CFAs and the analysts of the actual fund that are doing the micromanaging and moving in companies constantly on a day-to-day basis, moving companies in every week to see what their quarterly reviews are and stuff like that inside the actual fund itself, predicting the market analysis about 3 to 6 months in advance. So you're looking at like really 3 aspects. So people ask me, well, why should I go with a managed fund if I can just go day trade myself or trade ETFs or index funds? It's because of that very reason. Are you telling me that, look, if you really think of it logically, some of these funds I'm dealing with, let's say the MER is an average of 1.5 to 2%, okay? And most of the ones that I'm dealing with, they're over $1 billion worth. So $10 billion and say 2% of that, what is that, 200 million? Am I right? You guys, so hold on a second. So people who come to me and they make that argument, they say, well, can't I just do my own investing and make my own decisions when it comes to index funds or ETFs? I say, so you're telling me that you can do a better job than an asset management company that's been around for decades, pays analysts, researchers, and CFAs $200 million a year to watch for this one fund to make sure it outperforms the markets. You're saying you can do a better job than they can? How does that make sense? Think about the resources that they have with those $200 million.
Oh, yeah.
Put people on the ground and get people researching on different fund companies. It's a no-brainer. So it's just kind of silly, but they see videos of Robert Kiyosaki, who is a great investor at his time. I think he's gone a little off the rails these days as far as what's happening. But they see that and they're like, oh, I got to go do this and I got to go do that. And then they realize they're no match. I've had so many clients who actually were my clients for a couple of years. Then they made the decision to go trade themselves, invest themselves. They lost about half of their earnings of what all I made them. Then they lost half of their capital. And the next year they came back to me and put their funds back in. And they're back up, like I said, 23%. So it's just something I see on a day-to-day basis all the time.
And what's the there's interesting. I was hearing about, maybe you can give us more details on this if you know. But I've been hearing about this Aladdin that does all the trading for the top companies, and basically it's like an AI that studies everything online, all the news, trends, everything, and then just tells them what exactly is the next big thing.
So this is the point. That's a really good question. Obviously a lot of companies using AI, but AI is not the sole thing that we rely on. Like, for example, in this case, what you just mentioned, that type of AI is using to predict and study trends that have happened.
Yeah.
But look, history doesn't always repeat itself, but it rhymes. I can't remember who said that, but they said history rhymes. I think it was a writer or a poet, which means that it doesn't repeat itself exactly, but it will have something similar that happened prior to. So what that AI generated, robot is supposed to be doing is calculating the probability of history repeating itself or rhyming in one way, sense, or another.
Yeah.
But there's still things like the black swan that can happen to the markets, which is what we saw.
Yeah.
Right. And that's why it still takes a human aspect to come in there and deal with it, first of all. Right. That's why you still have people now. You can't run somebody to the ground, making them work 24 hours a day. Right. Even guys like I was talking about, Mark Schmel, the portfolio manager, he's still got to sleep and eat and poop and do all these things. Right. So while that's happening, he's got his team of research and everybody else, and he's got that AI working for him, generating probability causes for the next, whatever, couple months or a couple.
So it basically helps them to get all the information, right? And then they, like you said, right, you don't have to watch the market do all this research. You just take the summary and make the decision.
Yeah, but it's basically still the human brain to make those final adjustments. Because at the end of the day, Like it's the same thing as having an Apple Watch or some kind of watch that tracks like your heart rate, your blood sugar levels, all that stuff. At the end of the day, it still takes a doctor to tell you exactly what's good for you or not good for you, even though you get that data analysis now. And that's the world that we live in. That's why I'm so grateful for everything that we have. I think AI is great when you use it for purposes like that, right? It's not
That's
like
right.
there's this giant computer in freaking the head office of Fidelity that's doing all the work, and then they're just like laughing. They're
Yeah,
ha ha ha. We're gonna charge all these
you need
MEs.
all, yeah.
We still have a ton of people on the ground that are making the final, executions, final decisions. They see, okay, hold on, even though the AI has generated this trend, that's a 82% probability chance. There's still 18% of this, and this might happen.
Yeah.
And that's where human brain decisions, gut feeling comes in, right? You can't replace that gut feeling,
That's right. Yeah.
especially if you're got a healthy gut. The gut feeling is really good.
You have to have a healthy gut too.
Yeah, exactly. And we got a podcast for that too, guys. So if you guys want to learn about how to have a healthy gut biome, we'll talk about it. But
yeah,
for instance,
okay.
with the black swan of COVID or with 9/11, like how the hell is AI going to predict that? You know what I mean?
Yeah,
Or how is it going to generate you? Like, let's say we have the AI that we have today back in 2001. How is it going to generate the probability causes of human emotions based on something like that? What if that's never happened before? Has COVID ever happened before in the time of the technology we have? No. So what is it going to generate? It's going to generate you zero data from the previous. It's going to generate you data from Renaissance books about the freaking bubonic plague. Like, what is that going to do for the COVID? You know what I mean? Like, it's completely different.
Maybe a Spanish flu, but I don't think that there was much data back then. But let's move on the next one. We got one final. I don't know how much you can share on this one, but can you share a specific success and failure from your investment journey and lessons learned from each? So let me read that again. Can you share specific success and failure from your investment journey and the lessons that you learned from each?
Successes and failures from my investment journey. My personal one, or like the ones that I typically do for clients, or both?
I'll let you choose.
I mean, man, where does it start? Before I even got into this, the reason I chose wealth management rather than like day trading and everything like that is because I went through stocks. I went through day trading all by myself. I did the Forex thing, right? I did the currency exchange Forex. I did crypto trading, all that fun stuff. And I mean, I've been part of all those groups and all those things that seem like a scam or an MLM and all those different things that we have to pay money and they give you like codes or trading values and stuff like that. And you're part of a group chat and they give you suggestions on how much to buy and how much to sell or what companies to short. I did all that. I don't know, man. I probably lost or spent about $20,000 to $30,000, maybe more. There was nights where I would, make like $5,000 and go out and celebrate, and then I would forget to sell off before the weekend, and then I'd wake up and whatever Monday I lost like $7,000. So it was just like it was very hectic. I think that it's not the money that I cared that I really lost. It was the emotional roller coaster every day of not being able to be present. Right. A big part of what we teach with Life Rocket University is happiness. 3 pillars of happiness: health, wealth, and relationships. Right. You have to be present to enjoy those 3 pillars. I remember going on a hike with my lovely fiance and my dogs, and every 5 minutes I was checking my trades. I mean, I was up on a freaking mountain in hiking boots and everything, and I just couldn't stop looking. And I had so much anxiety all the time when I would see that I was going down in the red. So like the reason I stepped away from that is even though there's a high potential probability, you'd almost have to be so extremely desensitized to it to actually have a high quality of life. In which case, I don't know how you can be so desensitized and then still enjoy life because it's just so stressful. I feel like, I don't know what the probability is, but that's like they say the most stressful job is the airplane. The guy who gets the planes to land and gets them to take off.
Like the air traffic controller?
Air traffic controller. I feel like it's the same thing in the markets. It's very, very similar because things can change in a matter of a second, especially with something like foreign exchange currencies, Forex, because it's just such micro changes. And I was leveraging a lot. So I was leveraging like 1 to 5 or 10, 1 to 10 sometimes, which means that you're borrowing 10 times the value of what you have. So if I put in 1,000, then let's say it's leveraging me 10,000. So if I gain, anyways, that's not my point. So that was kind of my journey as far as the struggles. And I don't recommend doing that to people if they want to just completely have this, unless you're like extremely young, you have no responsibilities and you don't really care about what's happening to your money. And unless you're extremely wealthy and that's just something that, you get your kicks out of and you use it for fun, as long as you don't let it swallow you. Like if you're a gambling addict, you just stay the hell away from it. If you're trying to build wealth, you should probably stay away from it as well, because it's not a consistent way to build wealth, right? Like,
So what I'm hearing is just like choose something that is not this quick gain, but rather like a longer term commitment where you can predict a little bit more of the outcome than.
The best investor of our time, and many people can agree, is Warren Buffett. He's done really well over his time. The question was that when interviewers came up to him, they said, Warren, your investment strategy is so simple. See, that's where I got that from, keeping it simple. Why don't more people do it? And what was his answer? You guys know?
Because they think it's too simple. Can't work if it's too simple.
Josh, what do you think they said?
They said nothing good comes easy.
Both of you guys are indirectly correct. He said, because nobody wants to get rich slow.
Yeah, that's right. And so now we have a few minutes left here. I just wanted to touch on, one of the biggest topics here with, and that's crypto, right? Because there's a lot of buzz about it. There's a lot of talk. From your financial investment standpoint, what is in your expertise? What's your take on all that's been going on with the crypto?
Well, I think that everything I just went through and explained, it kind of summarizes my opinions in general about it. But I mean, just like if you keep it simple to what I just said, like, can it go to zero? Has it
Possibly.
always grown over time?
It's volatile.
Extremely. So again, I mean, it depends, man. Like what is an investment? Like, are you looking to grow your wealth? Are you looking to build wealth? Or are you looking to just have some fun and maybe make millions a little bit just by the stroke of luck? I think everybody wants to make millions by the stroke of luck. But look, let me be very clear. Even if you like nowadays with stocks or crypto, even if you're putting in like 10, 15, 20 grand into it, it's not going to be that big of a difference. Even if it goes up 200%, that's only what, from your 10 grand you went to 30. That's not that much. That's not going to give you financial freedom. You know what I mean? You almost have the same probability, and you probably do it faster. Go and put 10 grand on black on roulette table and see what happens. You have a 50 or 48% chance of getting it. 48% chance, and you got to double it to 20 grand in one day instead of waiting for crypto to do this thing. So that's my opinion. Because when it comes to wealth management, people come to me and they said, hey, by the time I'm 50, I want to have this much money. Hey, by the time I'm 35, I want to be able to buy a house. Hey, by the time I'm 42, I want to be able to start this business and sell my business off and do all these things. So I'm not going to go off of based on probability of what might or might not happen. Or what would happen to Bitcoin if they found that massive crypto wallet that was somewhere in the ocean or whatever, in the garbage that guy lost? What is that going to affect it? I'm sure that'll affect it, because now a bunch of more currency is going to come back into play, right? And that guy's going to be like the #1 wallet holder in the world. I'm sure there's somebody literally wasting their life away searching for that thing as we speak right now.
Like treasure.
Code, yeah.
Yeah, it's literally treasure hunting. So I don't know, man. Like my best answer to people is the same thing as they think getting into the real estate market is so easy and you're going to be a millionaire. Look, even if I saved up, Michael, do you think I can like flip a house in a year and make $1 million profit?
No way.
I'm probably going to lose money flipping a house in a year, right?
So it's like real estate that's the place where the long term pays off, right?
That's not just the real estate's the only place.
It's everything, yeah.
It's everything worthwhile is going to take some time to build. But look, like I said, if you have, there's things that can improve the speed or the efficiency of the returns or results you're getting, right? Like I said, for example, I have this one client who his pension was locked in with his job, and it was unfair what they were doing. They weren't allowing him to release his RRSPs. And I could get him much better management. In fact, I was getting much better management with his TFSAs. What ended up happening is I fought with them, and then I finally got him to quit and then subcontract as a self-independent guy to that same company. So we found the solution to pull out his RRSPs. We transferred those into some of the funds that I was managing in April, and that was about just north of $300,000, like 305. And right now he's sitting at just over $378,000 in the span of that. That was actually by the end of the year. So that's the update I sent him in December. So not even now because it's February already. Time flies. But so April was the 4th month, December is the 12th. So in 8 months, the guy made about $73,000 with me, just in profits. Now, is it going to trend like that every single year? I don't know. Probably not. But I'm going to do my absolute best to make sure it does.
Yeah.
So,
well, I think, it's interesting. I've been looking into crypto, trying to figure it out, right? As everybody, I guess. And, there's two sides to it. Basically, it's all gambling.
While you're trying to figure it out, and while the rest of the world is trying to figure it out, we got guys like my client who just made $73,000. It might not be as much as if he invested the whole $300,000 into Dogecoin or whatever the hell, or Bitcoin, if it's like that. But he's moving there slowly and progressively.
Yep. And, my couple takes on this is I think that the technology behind it, it's pretty interesting, the blockchain and how it works, the electronic ledger and how, like, I think the technology is definitely something that's going to be adopted in the future. Just because I had this experience, right? I'm in the bank waiting in the lineup. There's a guy who wants to deposit his check, and the lady say, we're going to have to hold the money for 4 days. This guy's pissed off. He was like, well, I need to pay some bills. I need to get some money. I like, can you do it like faster? And she's like, no, can't do, because this check is, we don't have this account. We didn't pull the money from there. So we have to verify it 4 days within Canada. Like, he wasn't from another country, right? And with crypto, you literally can make transaction, take seconds. It's verified. And think about it, it's been there for a long time. And I think it was Obama that said that really, like, I think that why there's such a negative push from the government is that they see it as a threat, because now you have your Swiss little banking account or bank in your pocket, basically, that no one can get into. So the government is not able to go into and pull the money that you owe them for taxes or whatever, right? So I think that you really need to not just see the perspective that being told out there. You got to really look into technology and how it's being really used, and that, why has it been recently approved as well, like Bitcoin, and I think the XRP might be the next one. But there's a lot of things that are happening, and I think that the technology over time, it proved that I don't think it's going to go to zero, but you never know. Like, I think it's a gambling as well, as you said, but I think that people are not investing the time to really learn, and I think it's
Michael,
really changed.
Right now, you're not so much talking about finance anymore. We're talking about a capitalistic monopoly. We're talking about technology. We're talking about politics, and we're talking about conspiracy. So we're like, if you're talking about finance in general, do I think that there's a potential for the governments and the banking systems to adopt blockchain to help people speed up the process of depositing money? Absolutely. Absolutely.
Yeah.
But at the end of the day, I want to look, that's the effect. You're looking at the effect. This poor man couldn't deposit his paycheck and he had to wait 4 days. Let's look at the cause and effect. Okay. What's the cause? 100 years ago, 95% of us were self-employed and we were making money. We were going out there and making money. 100 years later, 95% of us are employees. So is it the bank's fault, or is it the guy's fault that he has zero finances to pay his goddamn bills, and he's done poor financial planning? He's been broke his whole life. He's working as an employee, struggling to make the payments, instead of he's using his body for the paycheck. When if we just tap into that infinite potential that we all have, I truly believe that man can go out, use his mind to increase his income. Okay, because if he has bills to pay, his family to take care of, he chose to have a child, he chose to have a girlfriend, he chose to move where he moved. He made the decisions to work where he works, and he made the decision to go home at 5 o'clock after his 9 to 5 and relax and kick his feet up and watch Netflix, instead of grinding his ass like I did for 2-3 years to go from construction to being in finance. And then he could be making 100, 200, 300 grand a year in the span of the next 6 to 12 months. That's entirely up to him. If you haven't seen it already, there's a video of Grant Cardone was placed in the middle of nowhere with nothing, and then within 90 days, he built $1 million company. That's just an example. So I think everybody, if they tapped into their inner potential in their mind, Like, but you're talking about something completely different. If we're going to be talking about politics or capitalism or whatever the aspect of a man's mind, I think if he applied himself a little bit more, that guy wouldn't have to rely on the bank to check his money in for the next four days. And by the way, if you have a great rapport with a bank, they're going to take your money on credit, and if your check bounces, then they'll bounce it back. But right now, I can deposit a check for 15 grand and I can take it out right there and then, even though the check hasn't cleared, because I have a good rapport established with my bank.
Yeah.
So again, that's his responsibility for doing that, right? So
yeah, and I totally see your point. However, I think that there is, what I'm saying, that the existing banking system is quite archaic and it doesn't meet the needs that are existing now for a lot of, maybe you're in a different situation and you have you don't have this problem.
Like
But there's a
we're-
lot of people that do have this, right? So I'm sorry, I'm thinking that, there's good, like, I understand your point and I totally agree with you, like he shouldn't be in this situation, but I think that there's more likely there's more people in his situation than people with situation where they have enough money and they don't need it, right? So I'm thinking that the way that the system works now, there's this technology that can allow everything much faster. And I think that maybe it's, not, maybe there's going to be another one, but I think that the technology, as you said, it's not investing, but I think that technology out there is going to be implemented because it makes sense.
Yeah, that's an entire possibility.
Yeah.
But again, if you look at the banking systems, then we have to blame the education systems. They haven't changed in the last 100 years.
Well, everything is kind of, political system, like everything. I think it has some room for improvements, right?
But we can't follow the majority. That's what I'm trying to like.
Well, 100%.
Scream off the rooftops. Look what following. This is why I don't like the topic of politics. I don't get into it very much because where has following the majority gotten us so far?
If you're interested in exploring more topics like today's or have suggestions for future discussions, we'd love to hear from you. So please leave a comment below. To find out where you stand in the 3 core areas of your life, health, wealth, and relationships, take our free assessment at liferocketuniversity.com. We will see you next time at the Life Rocket University Studios.